Today, I'll explain you why we did not invest in GSM foils despite great quarterly results. GSM Foil is a manufacturer of pharmaceutical blister foils and aluminum packaging and has experienced several significant operational, financial, and corporate developments recently. The share price of GSM Foil has dropped from 295 to 155 now, which is almost 50% drop in few days. The company is in lower circuit with no buyers in sight. Recently, Chairman Sagar Bhanushali was arrested by law enforcement following an investigation into an attempted attack on Managing Director Mohan Singh Parmar on July 24th. The event reportedly stemmed from a 30 crore financial dispute and debt pressures. Why did GSM Foil first of all came into my radar? Here you can see the quarterly profits were increasing, and they were not only increasing, they were increasing by leaps and bounds. In last quarter, the profit increased from 3.42 CR to 6.28 CR. And in this quarter, the profit increased from 3.8 CR to 7.62 CR, which is almost 100%. So the sales also doubled and the profit also doubled. Still, I did not invest in the company because I identified few red flags. But before I tell you the red flags, let me tell you something more about the company. The company recently signed a MOU with AAPL Solutions to enter the roll-on pilfer-proof cap segment. This expands their addressable market into liquid pharmaceutical syrups and beverage bottling ceilings. The company notified exchanges regarding the leasing and installation of machinery in new unit at Vasai, Maharashtra to boost short-term production bandwidth. The company had also planned Ahmedabad plant expansion. Utilization of capital raised via 23 CR rights issue continued towards setting up and operationalizing the new plant in Ahmedabad. Despite such positive news, we did not invest in the company. So let us quickly identify the few red flags. The biggest warning sign was profit without cash flow. Here we can see that almost 25 CR of profit was garnered in the last 12 months, but the cash flow were negative. So the cash from operating was minus 37 CR. So the cash conversion comes out to be minus 122%. The biggest reason was receivables, which was almost 94 CR. The second warning was mismatch between growth and physical assets. In last 4 years, the sales increased from 27 CR to almost 300 CR, which is more than 10 times. But there was no capex or hardly any capex. The fixed asset is hardly 5 CR. So from 5 CR, the company is garnering 300 CR. If it was a trading company, maybe I would have overlooked it. But it is a manufacturing company. It had recently raised the 23 CR also. The third red flag was the repeated requirement of external funds. After its IPO, it raised approximately 23 CR through its rights issue, with 20 CR intended for working capital requirements and not for major capacity expansion. Finally, I could not find a widely available credit rating from a major rating agency. Absence of a rating does not prove anything wrong, but it removes an important layer of independent credit risk. Mostly, for a newly listed company, I ignore if the investors are offloading their shares. But we can see from 73%, in 2 years' time, it had come down to 54 CR, which was another red flag. If the company is signing MOU, is expanding, and the profit is doubling every quarter, why would the promoters sell their stake? The lesson is simple. Never only invest because sales and profits are rising. Always check operating cash flows, receivables, inventory, capex, repeated fundraising, credit ratings, and management quality. An unexpected event cannot always be predicted, but financial red flags should never be ignored. Follow and subscribe me for such insights. You can also join my Telegram channel link given in the description where I suggest companies after deep research. Thank you.